Hey, good evening, everyone. Marty Mazzora, July 23rd, 2021, weekly macro update. So in this morning's morning note, I said that I had a lot of pithy stuff for you that I couldn't wait to get to. As I sift through it, pretty redundant, meaning a lot of the same messaging that I've been giving you of late. So rather than spend 20 minutes looking through analyses that for the most part you've already seen, let me just cap that part, talk about our index, show you the things that moved, and I'll peruse some of the notes and see if there's anything else that I want to offer up. The things that I would dial up that I would talk about would be essentially related to the questions that I featured in our weekly message this week. And I'll just read them to you real quick. Will the Fed implement tightening measures to slow the risk of higher inflation going forward? Utterly no would be my answer. They'll say we have the tools, and they do, but they absolutely unequivocally will not use them for the fact that equity markets are so levered in a sense. Boy, they are politically levered, let's put it that way. When you think about the fact that households have more equity as a percentage of their net worth than they've ever had. Pension funds have to earn their bogey, and there's nothing in the fixed income world that will do that for them. The powers that be have effectively made people look at stocks like the only place to get a rate of return. Therefore, the stock market cannot be allowed to go down. This is a mess. No ifs, ands, or buts about it. Doesn't mean that it's not going to go down. Doesn't mean that Monday's, at one point, I think, 1,000-point decline in the Dow didn't make some sense, in the bigger scheme of things. But really, what made a lot of sense relative to what we've seen the last, couple of years is it got bought up really, really quickly. That speaks to the liquidity that's still sloshing around out there. And it speaks to the mindset. That is the mindset in late stage bubbly markets, right? Buy every dip. It's just very, very one-sided, okay? But there is so much, and I'll use the term again, leverage against it that would just utterly tank the economy and the careers of politicians and political appointees in places like the Federal Reserve, that it just cannot happen, right? Number two, will the Delta variant derail the reopening of the global economy? Can't know for sure, but politics say no, right? According to what I'm reading and studying to the extent that I have access, and what I just read before I turned on the recorder here, was that in areas that were not vaccinated, and only about half of the US population is fully vaccinated, people are starting to show up in the hospitals again. In other parts of the world, it's worse, and some of them it's better, but there does seem to be a correlation between the severity of the sickness and whether or not the patient was vaccinated. Okay? So there's some risks there, but locking everybody down again like that, it's going to be riotous, I think. So let's say no. Number three, will politicians come to terms on meaningful infrastructure investments to the tunes of trillions over the next several years? Yes, I think we're probably within a week away of getting the bipartisan deal that's, $500-600 billion. And then shortly thereafter, via reconciliation, we're talking another $3.5 trillion. So this recent dip in our favored trade, which, as I said earlier in the year, just went too far too fast, I think it has to do, and I wrote about that, it has to do with the Delta variant, I think, and fear of slowing back down. And it has to do with sentiment as well. And so if we don't have everybody just pounding, free money into the economy, so to speak, then won't that slow the inflation train? Well, when you look at all the business surveys, and several of them came out this last week, there's nothing in those surveys or in the earnings calls, because we're in earnings season, that says inflation at the wholesale level and inside of companies is remotely slowing down. If anything, it's accelerating, right? So the trade, though, was, buy bonds again, forget this inflation trade and so forth. So there are two really big camps. It's almost like the cryptocurrency and then the old farts who don't believe in it, yelling at each other. It's kind of how the inflation debate is today. Now, clients, I think you appreciate this, just like us owning gold now for the first time since 1999, we just don't do ideology when it comes to investing. There are people, and I know some of them, who just think the world's finally going to come to an end, and every time they print too much money, it creates a bullish scenario for gold, or you need to do that because they're going to kill the dollar. Well, I had a lot of people telling me that in 2008 when they were printing like crazy. I said, the overall setup does not demand or inspire me to get into the gold trade with a long position. And it did go up, and we had that peak when everybody was throwing gold parties, right? And then it came crashing back down, and now we're back up there again. But this fundamentally is the setup for gold. It's when you have, in this case, a debt bomb, and you have a scenario where the Fed can say they can fight inflation, but they can't. They will not raise interest rates for virtually as far as the eye can see because they blow up this debt bubble. They will try to taper back their monthly asset purchases. They'll try with the mortgage-backed securities. I suspect the market will roll over hard, just like it did in late 2018. And then they'll stop and they'll say, I'm sorry, I'll never do it again. And they'll print a bunch of money and they'll boost the stock market back up to valuations that, when you study them historically and you go out 10 years, give like zero odds that you're going to make much money in the US stock market from these levels. Doesn't mean you won't, because you're going to have a lot of artificial pumping unless we get a political regime change. I think midterm elections next year are very dangerous, right? We have some gridlock that does not allow for a continual pumping of the economy. Now, they will have already passed a ginormous infrastructure bill that will continue to help. And the powers that be desperately need that politically going into the midterms next year. But if as often happens in first terms, if the other party prevails, it'll be very interesting to see what happens. But that's fall of next year. What happens between now and then? Well, we deal with the Delta variant. We come out of that. Suddenly that trade that was phenomenal the first few months of this year that we're in comes back, and people start believing again, in the whole inflation trade. The fourth one was, will world leaders keep their sights on curtailing carbon emissions and aggressively promoting renewable energy sources going forward? Yes. Number 5, will governments, including China, along with their central banks, step in with stimulus anytime their respective economies threaten to roll back into recession? Yes. Will governments continue to cater to generally populist, anti-global sentiment within their own jurisdictions? Of course. So every single one of those answers make perfect sense, and I think odds strongly favor structural inflation after we get the come down a little bit after beyond these bottlenecks and things that we got because of COVID. So what do we do with that? Well, the areas that are going to benefit from the legitimate attempts to do something real for the economy, a la infrastructure, those things are valuable. We're talking about commodities coming out of a 10-year bear market. We're talking about also, when you talk a weak dollar, international securities that have been so grossly underperforming the U.S. like they have in seldom periods historically. And when you can find similar periods, you see huge outperformance for the next decade, right? And then to the extent that you're in the U.S. market, you're in the materials, right? You're in the resource stocks. You're also in some tech. I'm telling you what we are. And healthcare and staples and all those kinds of things as well. But I don't think at any time in my career was the coast so clear in terms of the obvious places to allocate assets, or at least to tilt toward. The risk is there, a policy misstep, and stocks are off a ton over a very short period of time. So we've been hedging since late summer 2019, mostly just calculating the potential volatility of portfolios relative to the S&P and then using the S&P to hedge it. Our portfolios evolved to the point where we're not very correlated to the U.S. market. So like we did here, the last week or so with energy, like we did previously with gold and with ag, we're going to start to do more hedging individually on the short-term frothy looking things, I wrote about the energy hedge that we did. It worked out beautifully. I got with Nick. We discussed my macro thesis, and I said, you got to love energy immensely for the next few years, right? There's just going to be very little capacity build out and huge demand coming, despite the whole push for renewables. But in the near term, OPEC's probably going to get back together with the UAE and allow for additional output. That'll be a depressor on the price. And you've got this darn Delta variant of COVID. And if that really turns out to be a thing, you take those two things together and you get the perfect storm and something that we're up, a bunch in. So I want to hedge that, say through October, and let this thing play out. So we had that discussion. Nick put the hedges where they needed to be on two positions. As it fell, Nick said, we should get our cost out of this at least and just roll it down a little bit and keep meaningful protection. That's exactly what he did. And so we're in energy with a free hedge to keep it from being really, really ugly if it does indeed roll over. Okay, so let's just do the macro. And as usual, I'm taking more time than I thought. Not a great look there, right? Really rolling over, down 6 points this week to 29.50-ish. Stimulus come back and so on and so forth. I'm not worried about a recession anytime soon. Oh, by the way, the National Bureau of Economic Research did their thing, and they're the judge of when we're in recession. Last year, steepest recession on record, lasted 2 months. So my oh my, the power of printing trillions of dollars. Whew, the lesson that the powers that be just learned about the ability to juice the economy. We'll just have to see how this plays out on the other end of it. But does it add to the risk? Sure it does. Do they have to spend a lot of money to support what they've done here? They do. Is it going to be on infrastructure? Yes. Are we going to be there to exploit it? Absolutely. We had three negative needle movers among our data points. One was housing permits. I gave you the detail on that in a morning note earlier in the week, so I won't go into it too much. But yeah, they're rolling over. Third month in a row. Rate of change looks really ugly. Not a good look. Is it because people are losing their jobs and we're about to enter a recession? Well, no, we have 9.3 million job openings out there. It is about houses being crazy priced, and we can thank the powers that be and all that stimulus for that. Speaking of losing their jobs, we did get an uptick in jobless claims to 419, so we went back up above that 400 mark there. This one is interesting and is somewhat concerning, I have to be honest with you. So this is my ratio, sector by sector, the main sectors with the S&P. The only thing over the last month that outperformed the S&P was tech. 103 means over the last month it's outperformed, say by 3%, the S&P 500. Well, financials have underperformed it. Even consumer discretionary, almost tied, but it's underperformed it. Materials, underperformed it. Energy, hugely underperformed it. Good thing we hedged that. Industrials, underperformed it. Staples, underperformed barely. Utilities, outperformed. And healthcare, outperformed. So this says the economy is slowing down, and our index makes perfect sense in that it looks like it's rolling over. Again, I don't think this is long-term phenomena at this point. We'll have a different conversation if our index gets into the red, but this is my position right now. The Bloomberg Commodity Index just peaked above this high right here. That's looking like that could be a breakout. And that's going to be great, right, for our inflation trade. And we're not the least bit overbought at this point. This red line, this big red line, captures the long-term trend. So let me zoom out and put that into context for you. From the peak in 2008, commodities have been in a long bear market, just now breaking out here. As I've said it multiple times here, moves tend to be extended moves. Like here's a bull market that went further back even than that recession. Peaked, long bear market. Breaking out of this range right here is bullish. You can see where we broke out of this range right here as well. And it could be bullish for an extended period of time. It certainly plays into our thesis about inflation. And I did throw up the dollar chart, so I'll do this and I'll finish here. So we do technical analyses on a ton of currencies as well as every position we have. So the dollar, as I said, if you get the dollar right, you're going to do really, really well. So if the dollar goes up, the world's going to come to an end. Not being facetious, we'll live, but the financial world's going to feel like it's coming to an end. I think you've heard me say it before. You've got the equity markets, you've got the debt markets, and you have the dollar. And something's going to have to give before this is over. It's going to have to be the dollar, and that's the inflation I'm talking about. And these technical indicators are saying that the momentum is waning, and if that's true, then we should see the dollar come down through here eventually. That's the tune I need to keep humming for you to help you understand, especially you clients, why our mantra is reserve principal here, earn a decent rate of return, compound it, and be in a good spot if and when things roll over hard, to take full advantage of that with what liquidity we have, and we'll have a ton with the hedges if that happens, plus we're sitting on quite a bit anyway. So folks, I'll leave it there. I hope you all have a wonderful weekend. We do appreciate you watching these videos. Take care. Thanks again. Bye-bye.